The first quarter of the year had proven to be a relatively buoyant one for global markets, and this was reflected in the performance of the three factor funds. The most recent 3 months, the second quarter of 2015, was a more difficult period for global markets, and this has inevitably weighed on returns over the period. Factor 3 was down 1.7% in the quarter, Factor 4 by 1.3%, and Factor 5 by 1.5%. This performance, while disappointing, compares reasonably well with a return of -3.3% for the UK equity market and a return of -3.6% for the UK gilt market. Year to date, the funds are still in positive territory, up between 1.5% and 3.5%. It was something of an unusual quarter because both the UK equity market and the gilt market sold off. Despite that, for sterling-based investors, the single most powerful decision you could make in the quarter was to remain invested in the UK. This is because other regions' equity markets, for example, performed similarly poorly, but sterling was strong, which added a headwind to performance of these foreign assets when their returns were translated back into sterling terms. Overall, global equity markets were down 5.3% in sterling terms for the quarter. It's a similar story in the bond markets, with modest local currency losses being compounded by a strong sterling to culminate in a return of -6.8% for the global investment grade bond index in sterling terms. Within the fixed income allocation of the funds, the relatively low interest rate sensitivity, or duration as it's known, was a powerful contributor to returns, as the bonds with lower interest rate sensitivity preserved capital better than those with higher duration. The credit allocation didn't aid performance, however, as the exposure to corporate fixed income was not well rewarded over the quarter. The funds also benefited from manager selection decisions over the quarter, especially within the equity allocation of the portfolio. This goes some small way to demonstrate why we believe there's value in blending high-quality style-specific managers, because their value add has come at a relatively difficult time for the equity market, and this shows the benefit of having a variety of returns drivers in the portfolio. Markets today are ebbing and flowing, and in these sorts of conditions, our views of valuations will not change much. As a result, we've not seen the need to make significant alterations to the investment approach in the portfolios because we believe their positioning over the quarter is still where we want to be looking to the future. There have been some minor tweaks to positioning, however. For example, in the fixed income allocation of the funds, we've moved to a new loans manager. We've also reduced equity slightly through the whole range, and within the equity allocation of the funds, we've sold from our Polar Japan position and added to our European equity exposure. The reason we've done this is because we believe the recent bad news with respect to Greece is weighing on European companies more than it should, and as a consequence, we've added to European names that look well priced. We still think the UK and European stock markets are attractively valued, and as a result, we want to have meaningful allocations to those markets. On the contrary, we're deliberately underweight to the US because we believe it to be expensive. Within the fixed income buckets, we're underweight gilts and overweight a variety of areas of the credit spectrum, including investment grade, high yield, convertible debt, emerging market debt, and loans. We retain a reasonable cash balance as well, as we think it's a reasonable value compared to government debt, and also it's very useful to put to work as and when valuation opportunities present themselves.